Hi, I'm Lena Riscala. The last few weeks have been very hectic in the markets. Last week, both the Nasdaq and S&P 500 entered correction territory, and despite a positive day on Friday, the S&P still saw its fourth week in a row of losses. Understandably, this has many investors feeling very nervous, but I wanted to share some thoughts here to help put things in perspective. What does this all mean? With a new administration comes a little certainty, and in this case, a lot of uncertainty. On the campaign trail, President Trump had talked about putting additional tariffs on non domestic products, and to the surprise of many, he's actually making good on those plans, at least in the short term. Higher tariffs and reciprocal tariffs could cause inflation and interest rates to increase, and probably are not good for the investor in the long term. It's also likely that the Republican-led government will extend the tax cuts resulting from the 2017 Tax Reform Act. The extension of the existing tax cuts will likely increase the budget deficit alone, but any additional new tax cuts will create more of a shortfall. Other policy changes like immigration and deregulation could also affect the market, but it's too soon to find out. How should the average investor be reacting to the new administration and possible changes? Well, it might be easier said than done, but think of this market volatility and political uncertainty as a moment in time. This chart reflects all the different political, economic, environmental, and other moments from 1970 to the present, and the upward trajectory of the S&P 500 despite all of those moments. Of course, in many cases, the market will react to the moment in the short term, but for long-term investors with diversified portfolios, the more time in the market, the more likely they will capture the upside as long as they sit tight. But first things first. Before making investment decisions, make sure to have a financial foundation, an emergency fund of about 4 to 6 months of your necessary expenses, no or low debt, and make sure you're taking advantage of your employer match in your company 401k. If you can save beyond that, try to max out retirement savings as much as you can. But for any additional or extra dollar beyond that, consider your investment goals and the time frame, like when will you need the money, and that will help you determine your investment strategy. If you're saving for the short term, it might be wise to keep your savings in cash. If you have a few years before you need to access the money, consider putting a portion of that savings to work in the market. If you're a long-term investor, you can add more risk to your portfolio. The bottom chart shows that the longer you're invested in the market, the more likely you'll see positive returns and less likely to lose money. So take on risk when it makes sense. This chart is what we like to call the Skittles chart. And guess what? Skittles is more than a snack. For long-term investors who want to avoid a bumpy road, make sure to invest in a diversified portfolio. This Skittles chart shows different asset classes and their returns in various years. The lesson here, nothing stays the same. And so you don't want to put all your eggs or your orange Skittles in one basket because your investment could be up one year and drop to the bottom the next. Look at REITs in 2015 and then in 2016. Also consider the other type of risk, like keeping your investment in cash, illustrated in the purple boxes at the bottom. To avoid this roller coaster ride, consider keeping your investment in a 60-40 mix, as illustrated in the gray boxes. You don't have to capture all the gains, just most of them, and in this way, take advantage of market returns while also protecting your portfolio from downturns and avoiding the drama. What goes down probably comes back up. Once you have an investment strategy that encompasses your purpose and investment time frame, stick with it. The more experience you have in the market, the more you should understand that the market is reactive and can sometimes be volatile. But this is normal. This chart shows the worst day in the market in a given year, illustrated by the red dot. It also shows where the market ended in the same year, illustrated by the gray bar and the number above it. The bottom line is that despite intra-year market drops, the average of about 14%, the market ends positively about 75% of the time. So even when things get scary and you want to pull out, don't be distracted by the headlines and stick to your guns. And stay in it to win it. Stay invested. The longer you stay invested in a diversified portfolio and avoid the knee-jerk reactions of jumping in and out of the market, the more likely you'll end up with positive gains over time. This chart shows $10,000 invested in a diversified portfolio for 20 years. Think about what can happen in 20 years. Terrorist attacks, wars, pandemics, droughts, unhinged rulers, etc. But being diversified and sticking to it over the 20-year period resulted in 10.4% returns for the investor on the left. The investor who gets spooked by the world and market events, cashes out, and then jumps in when he thinks it's safe, missing the best 10 days of the market, will see his returns almost cut in half. Remember that historically, the market sees its best days within 90 days after a market bottom, so don't miss out. Bottom line, understand what your investing purpose and time frame is to determine your investment strategy from the get-go. The longer investment time frame you have, the more risk you can add, but keep it diversified and stay invested. Working with a financial advisor can help you manage the biggest risk, our own behavioral risk. Consider the idea of loss aversion. Most people get their investment statement, see the gains, smile, and move on with their day. When we see losses, however, we're more likely to make a change, like pull out of the market and into cash, which could be detrimental in the long run. Working with an advisor can help you arrange your investments according to your risk tolerance and considering your experience with the market, but also according to your goals and time frame. We can help save you from yourself, but also help you look at the big picture and help you in all areas of financial planning, including family protection, retirement solutions, and legacy planning. Give me a call if you have any questions about the market, your portfolio, or any information I shared in this video. Thank you.